Interest in options trading has surged in recent years, and with retail brokerages clamoring to attract new customers left and right, it's now easier than ever to get approved to trade options. Fueled by the recent rise of highly volatile meme stocks, many new traders salivate at the prospect of earning a big profit with a simple click of a button on the options chain. But who is taking the other side of the trade when you decide to buy those out-of-the-money GME calls that you think are going to triple your account? Let's talk about the man behind the curtain, the market maker. Quick review, there are two types of vanilla options contracts: call options and put options. Buying a call contract gives you the right, but not obligation, to buy 100 shares of a given stock at a future point in time. If you hold an option through expiration and the share price is above a break-even value, you'll earn a profit. If it doesn't, you risk losing some or all of the premium that you paid when you bought the call. Put options follow the same principle but in reverse. Buying, or going long a put, will yield a profit if the share price decreases below a break-even point. Think of it as insurance against the drop in the share price of a stock that you own in your portfolio. You also have the ability to sell or write options contracts. You could sell calls against shares that you own in your portfolio with the hopes that they expire worthless, thereby allowing you to keep all of the premium from the option sale. You could sell cash-secured puts in the hopes that they expire worthless. Regardless of what you trade, you are not obligated to hold an option through expiration. Regardless of whether you are long or short options, you can close your positions anytime prior to expiration to either lock in a profit or limit a loss. Regardless of what you trade and when you trade it, someone is always there to take the other side. The market makers. Their primary function is to provide liquidity to market participants, retail and institutional alike. Market makers are usually proprietary trading firms that have special agreements with the options exchanges that require them to post bids, prices that they are willing to buy a contract, and offers, prices that they are willing to sell a contract. The offer or ask price is always larger than the bid price, and the difference in value between those two is how market makers earn their money. While the end trader may be speculating on the future movement of a stock, market makers don't have any directional biases. They will take the other side of your trade regardless of your conviction regarding the movement of the underlying. Market makers are similar to currency exchanges. It does not matter if you want to exchange dollars for euros or euros to dollars. A market maker will always be ready to do business and earn a profit by buying below and selling above the exchange rate. In options trading, the exchange rate is the theoretical value of the option, typically the midpoint between the bid and the ask. For options with a high trading volume, the bid-ask spread is relatively small and narrow. But when options have limited liquidity and relatively little trading volume, the bid-ask spread will be much larger. In a perfect world for a market maker, when a retail trader or institutional trader sells them an options contract, they will immediately flip it to a buyer and realize a quick profit from the bid-ask spread. While the profit margin from the bid-ask spread is not very large compared to the premium of the option, the number of contracts start to add up once the market maker starts flipping thousands and even millions of options. In the real world, however, market makers can't always instantaneously flip options. They have to take on inventory. Lots of it. And inventory means risk. Market makers view options as points in risk space. Lots of risk factors affect the value of an option price. Directional risk of the underlying, market volatility, time decay risk. These risk factors are constantly in flux, and as they change, the value of the option also changes. In order to be protected against these price fluctuations, which can be substantial, market makers need to hedge that risk in order to realize a profit from the bid-ask spread. They hedge by taking on offsetting positions which greatly reduce their overall risk exposure. As a basic illustration, we can plot a call option as a point on an XY graph where the X and Y axes represent arbitrary risk factors. Call them A and B. If a call is at the point 2, at time of sale, the market maker will need to create a hedge with an inverse position equal in magnitude at -2, -2. Now the risk factors offset each other, and the market maker is risk neutral. If market conditions change and the call is now at 3-1, the market maker will need to adjust the hedge accordingly to -3, -1. On a typical day, market makers are managing an inventory of thousands or millions of options, and finding perfectly offsetting positions for every option in their inventory is as impossible as it is impractical. Their goal is to manage and minimize their risk exposures for their entire inventory, not for every individual option. They are always taking on some risk. The amount of risk varies greatly from firm to firm depending on which markets they trade and their overall risk tolerance. The compensation for taking on that risk is the profit earned from the bid-ask spread. Next time I'll talk about the various risk factors involved, along with some basic strategies that market makers use to manage their risk. Thanks for watching, I hope you learned something new, and I'll see you next time.